here with MoneyWeb. My name is Hannah Barry and I'm talking to Warren Ingram of Galileo Capital about what to do if you are retired or retiring soon. Warren, what should you not do if you are retiring soon?
I think the thing to remember when you're retiring is that it's not the end of your life. So people tend to view retirement as the end goal and thereafter, I don't know if they think that they're not going to live much longer or what the deal is. So typically what happens is their company retirement funds, and I've even seen it with big banks, will tell them to move all their money in their retirement funds to cash. So they'll say to them in a year or two before you retire, don't take any more investment risk, rather have your money in cash so that if the stock market crashes, you're not going to lose all your retirement money, and then once you've retired, you can start investing your money again. To me, the problem with that is that you've missed the point that your retirement could be 25 to 35 years of life. That means for the first time in your life, as a retiree, what you've actually done is you've become a professional investor. So you need to extend your time horizons when you think about your money, not shorten them. And that's really always, to me, the biggest mistake that people make is it's now the end of life and I can't do anything anymore, can't take any more risk. In fact, that really is the problem. You have to worry about inflation, and that means you have to take risk.
But of course that risk should differ, I'm assuming, from somebody who has 30, 40 years before they get to retirement. So how chiefly should the asset allocation for a retiree or soon-to-be retiree differ?
To me, what you need to realize with your retirement money is your biggest enemy is going to be the impact of inflation on your money. So stock markets rising or falling are much like the tide. They're going to rise and fall many times in your retirement career, and there's nothing you can do to control them. So what you need to do is rather focus on inflation. And if you're going to focus on inflation, it means you need to have some of your money invested in shares and property. And if it's left to me, property companies rather than houses. So what I would say is, as an absolute minimum, you always need around 35% of your retirement money to be invested in shares, potentially up to a maximum of 2/3, 65, 66% of your money. Why? Because then you know that in that range, you will have sufficient protection against inflation, your capital will continue to grow, and you can draw an income, and you know that a major stock market crash is not going to wipe you out. You've still got some diversification.
You mentioned investing in property companies rather than actual bricks and mortar homes. What we have seen, sadly, in South Africa are instances where pensioners have invested all their money in property syndication companies, opportunities, and lost everything. So when you say property companies, what do you mean, and how can investors guard against that kind of an outcome?
Yeah, thank you. Otherwise, we'd be leading people down the path. So I mean property companies that are listed on the stock exchange, property companies that are well regulated, that have a good track record, and at least they're audited correctly every year, and you can buy and sell those shares literally with an instant's notice if the market is open. In other words, normal business hours. So that would be the companies that I'm talking about. We find people that are buying property syndications are typically people that are really in financial difficulty already. So what they're looking for is as much income as they can possibly get because they don't have sufficient assets. And sadly, the risk there is that because you've got a financial problem already, you take more risk. And really what you should be doing is taking less risk because you cannot afford to lose any more money. And unfortunately, a physical property or a property company that's not trading on the stock exchange, to me, represents a lot more risk because you're taking all of your eggs and putting them into one or two baskets, and that really is risky. So rather don't do that.
You mentioned some of the mistakes that soon-to-be retirees make, especially looking for high income yielding investments because perhaps they haven't saved sufficiently up to that point. In your experience, what are some of the other common mistakes that retirees make?
I think because for most people they become professional investors for the first time in their lives as retirees, they tend to let their emotions cloud their investment decisions in a dramatic way. And it usually happens in one of two paths. The first is that they become too conservative with their money. So because there's now the numbers are big and they realize that they could lose in a few months more than they've ever earned in a year, they don't want to ever do that. So what they do is they take too little risk and they take their eye off the big danger, which is inflation. So I think that's the first big mistake that a lot of people make is they always focus on stock markets going up or down, and they're so worried about that tide that's coming and going that they lose the sight of the thing that's really destroying the value of their money, and that's inflation. So that's really the one that I would emphasize over and over again if I could all day long. The second one is that they become overconfident in their own ability either to run a business or to invest in a business or to invest professionally. And you always see it with people who've retired and their children come to them and say, I'd like to start a business. Please, can you lend me some of your money and I'll give it back to you in a year or two's time. which is fine. That we want to support our friends or our children, but the point is that if you're not a professional investor and that this is the only money you've got, you shouldn't be taking too much risk. You should actually be trying to spread all your eggs across many different baskets.
Warren Ingram is with Galileo Capital, and I'm Hannah Barry of MoneyWeb.